Okay, exercise 1-2 and 1-3 are related. 1-2, we're looking at it from Falcon's point of view. And then 1-3, we're going to look at the same transactions from the other company's point of view. In accounting, we talk a lot about handshake transactions, where two companies transact. So let's take a look at this. So we're looking at this first as if we're the accountants for Falcon Company, and our company is going to purchase common stock of the other company. So when we buy the stock of another company, it's an asset. It's an investment. And it's an investing activity. Now, although we now own stock in that company, we're still going to do business with them. We're going to borrow money from them and sign a note. When you see the magic word note, I need you to think financing. So that gives us a liability because we borrowed money, and it's a financing activity. Next, Wildcat, the company that we bought stock in, pays us dividends. That's investing revenue for us. And the minute you see the word revenue, you know it has to be an operating activity, because revenue only generates operating activities. Now, we provide services to Wildcat, and although we own part of them, we can still transact with them, and that provides revenue for us, and that, of course, is operating. Revenue means operating. And last but not least, we pay interest. And interest is almost always an operating expense. So it's an expense and it's operating. Now, let's take a look at the same transactions, but from the other side. Let's take a look at Wildcat Company. Same transactions, but now we're the accountants for Wildcat. So this is exercise 1-3. Falcon purchased some of our common stock. So for us, that's an equity activity because we now have more shareholders, and whenever you see equity, you know it's automatically a financing activity. Then Falcon borrowed some money from us and signed a note. So we now have a note receivable. A note receivable is an asset, and it's an investing activity for us. Now, we had to pay some dividends to Falcon because they bought stock from us. Dividends is an equity activity. It's dealing with our shareholders, so that's financing. Then we provided services to Wildcat. We did whatever we did for Wildcat. So that's revenue. That's an expense. I'm sorry, I got it backwards. Falcon provided services to us. So that's an expense. An expense automatically is an operating activity. And then Falcon paid interest to us for the money they borrowed. So for us, that's revenue. And when you see revenue, you know that it's an operating activity. So I guess the takeaway from this is that the transaction itself doesn't carry any meaning. It depends on the transaction and the company's role in that transaction.